Hi students, today we are going to discuss chapter risk and return, and we are covering chapter number 11 and 12. Now this is the lecture outline, and we are covering all these 11 topics. But first of all, we are going to look at risk and return. How do we measure? We measure return using historical return and future return. And if we see the risk, we also measure risk using the historical data as well as future data. So our topic, uh, next topic would discuss how do we measure our historical as well as future return and risk. Okay, first of all is a simple relationship between risk and return. As we know that if we increase our risk, we can also, why do we take more risk? Because we expect more return. So there is a positive relationship between risk and return. And return is actually when you invest somewhere, when you are investing, of course you are expecting some return on your investment, right? So that is expected return. Expected return means you are not sure, but this is what you are expecting that you are going to get in the future, right? So a return is what you earn on investment over some period expressed in percentage term, or your expectation from your investment. Okay, and what is the risk? Risk is basically the uncertainty, because investment is normally for the future. Okay, so for the future, and as we know the future is uncertain, so what is the uncertainty? That you are getting less than what you expected, right? Risk means, first of all, in the investment you have some target that I'm going to earn this one, this is my average return. And risk is how sure are you that you are going to get R or more than R. But if you are getting less than R, that is your risk. So risk is the uncertainty, okay, of getting less than what you have expected. If you get more than what you have expected, that is not risk. But if you are getting less than what you have expected, is basically the risk. Okay, we will discuss in more detail. And also the return that investor requires from an investment depends on the risk associated with the investment. Okay, so if investor are uh, taking high risk investment, why is he taking that? Because he wants to earn more return. Okay, and this one, investor require greater returns for taking greater risk. And I will explain this point in these two statements. Number one, for a given level of risk, okay, for instance 5% is the chances of losing your money, so you would expect or you would invest in those assets that are giving you the highest return. For instance, A security is giving you 12%, B is giving you 14%, C is giving you 18%. So all have the equal risk of 5%. So for a given level of risk, you would choose the one with the highest return. Okay, and for a given level of return, for instance, C return is 18%, right? So you are going to expect security A has a risk of 5%, security B has a risk of 7%, security C has a risk of 9%. So which one would you prefer? For a given level of return, you are going to choose the asset that is offering you the lowest possible risk. Okay, so that is the statement. For a given level of return, we prefer the assets with the lowest risk. So this is one of the fundamental relationship in finance between the risk and return. Okay, so first of all, there is a positive relationship between risk and return, and number two, you need to understand these two statements. Now this is just a graphical depiction of what I just told you that there is a positive relationship between risk and return. Small stocks are actually very risky. That's why if you see their standard deviation means risk, right? So they have the highest risk. They are also earning the highest return, and they have some lower than this small stock. Also, they have the lower return. And if you see, if we decrease the risk, our return will also decrease. If you increase the return, your return risk, your return will also increase. So there is a positive relationship between risk and return. Now, to understand this relationship, as we know that there is a positive relationship between your risk and return, and as an investor, you want to, for instance, invest in stock A. So, when you are thinking of investing in stock A, what questions are coming in your mind? Number one is, how much should I expect from that stock? And number two, the question would be, what is the risk? And what does it mean? The risk means that you are expecting something from that stock, and what are the chances that you are not going to get that return, right? And how do we measure that return? How should you expect is basically the expected return. How do you measure it? Okay, so this is the first question. Next question is, what is the risk? And normally we call it as standard deviation. And how do we measure it? We are also going to discuss here. Okay, but first you need to remember that there are three terms: realized return, annualized return, and average return. These are the three terms I will explain. And for the risk, we have variance as well as standard deviation. So we measure risk using the variance, or in other words standard deviation, and we measure the risk return using uh, through realized return, annualized return, and average annualized return. Okay, next question is, how do we measure that return and risk? Basically, there are two approaches. Number one is one is that we have a historical data, and using the historical data, we can find return as well as risk. And also, for few stocks, we don't have any historical data. Maybe they are the new stocks. Okay, and we will use the future data, or the we will do some estimates to get the risk, return, and risk. First approach is historical data. Okay, so using the historical data, we are going to measure return as well as risk. Okay, now first of all is the realized return. As we know that as an investor, if you're here, okay, and the stock price is P, at time T, the stock price is P. After some time, the price would be at time t plus 1 would be pt plus 1. As well as the company, some companies, they also pay you the dividends, right? Whatever you earn from period pt to pt plus 1, the return from t to t plus 1 is basically called the realized return. Okay, so how do we measure the realized return? The actual return, that is rt plus 1, mean return at time t plus 1, is equal to pt plus 1, right? Mean the price at time t plus 1 minus pt, that is the capital gain. And some companies, they may pay or may not pay dividend, so rest the only would be capital gain. But some companies, they pay dividend as well, so your total return would be dividend as well as capital gain. Okay, so we also remember in the last topics that your total return should be equal to dividend yield plus capital gain yield. So if the company is not paying any dividend, so its total return would be capital gain. Okay, so that is called the realized return. Realized return means the return of a specific time period from t to t plus 1 in a year. Okay, but once we have the specific time periods in a year, when we convert it into year, it would be annualized realized return, or annual realized return. Annual realized return means that the So it is a specific 1 year, right? While realized return could be for quarter, could be for semi-annual, could be for month, right? So what is the annualized return? What is the formula? We simply multiply it by the periodic returns that you got, and you get actual return, or you actually uh, calculate the annual realized return. How do we get it? I will explain, okay, in the following part. Now let's see, you are given an example that you have purchased a Microsoft stock, okay, and on November 2004, and held it for 1 year, okay. The time period is from the investment period is 1 year, selling it on October 31st 2005. What was your annualized return given the cash flow timeline as below? Okay, okay. So what was your annualized return given the cash flow timeline below? If you see, on November 1, you bought this stock at 28.08, right? And after after on November 15, and the stock price was 27.39, okay, because you bought it on 28th, and on November 15 actually company has declared a dividend of 3.08, so that's why you are getting this November 15 date, right? And otherwise that is a quarterly one. Next quarter it would be after 3 months in February 15, the stock price was 25.39, and company also paid some dividend. On May 16, next 3 months, next quarter, was the price was this one, and 0.08 was the dividend, and the next quarter again in August it was 27.13, and the dividend was. So if you see, there are four dividends because in a year company is paying quarterly dividend, okay. So that is why when the company is giving you the dividends, you have to also look at the price. Okay. So next time, when the company is giving you the dividend, and you want to find the return, then you have to see the price. If the company is not giving you any dividend, so you are holding the stock from 28 to October 31st, then you will just compare this 28 with 25.70, because you are just holding it, right? But if the company is making some other returns also, is also giving you some dividends, then you have to also look at that total return after some period, okay. Now as you see, these are the periodic returns, periodic return, periodic return, periodic and periodic, okay. And let's see, how do we get the realized return. So it means the first return would be 27.39 with this 3.08. Next, how do we measure? That would also another realized return, another realized return, another realized return, and finally we sold it on October 31st. So we need to see what would be the total return. So if you see, the year is only 1 year, from November 1 2004 to 2005, okay. And we need to measure 1 year return, but that return is divided into 4 quarters. So how do we measure this realized return? From November 1 to November 15, so you are getting 3.08 as the dividend, plus this is the capital gain, right, divided by the original price, so that is the 8.51 in the first quarter, okay. So this is realized return of quarter 1, okay. But we can also measure this 8.51. How do we get this formula, by the way? Okay, let me tell you. We know that the price today is 28.08 at time t, and at time t plus 1, assume it's November 04. So we have a formula, Fe is equal to PV 1 plus R power n, right? So n would be 1 period, okay, because we are doing it for 1 period. So if I ask you, can you find this return? So you can find this return using FV. In other words, FV here is PT plus 1, and this present value is basically your PT. Okay, so I can adjust this formula. So this is actually future value and this is the present value. Okay, so in the future you are going to get 27.39 plus 3.08, right? You are going to get this one. So that is your future value divided by present value is 28.08. So it means at time t plus 1 you are going to get 27.39 plus 3.08 divided by the original price is equal to 1 plus r. So if I want to find the r, answer would be 8.51. So that is 8.51. Now for the next period, if you see from 27 to 25.39, so future value would be 25.93. Now 25.93 you are also getting some dividend, that is 0.08 plus 0.08 divided by present value. At that time present value would be 27.39 and your answer would be negative 5.04, negative 5.04. Lastly, if I just give another example from 25 to 25.49, so future value formula is equal to PV 1 plus R power N. What would be the future value? It would be 25.49 plus some dividends divided by the total so initial price present value. Our answer would be negative 1.39. Okay. So realized return, this is how you get it. 1 plus r part is here. So 1 plus r, 1 plus r, 1 plus r. So simply you get this answer, that is 2.75. Okay. Now in the previous slide, if you see, you just knew how to find this annualized return, right? So from 2004 to 2005, so what was the actual return that we got? That is 2.75. Okay, so because we are measuring the historical return, okay, so for instance, um, we are in 2007, okay, and you want to invest in stock A, right? So now the question is, how much should you expect from this investment? And for this one, you actually need some past data that can answer you, because you don't have any idea how much should you expect. So the past data, let's say we take the data of 2005, 6 and 7, and for instance 2005. Okay, so in 2005 we got the data, that is 2.75. And how do we measure this 2.75? We just got it. Okay, so this is realized return, annual realized return of 2005. Similarly, we can also find annualized return for 2006, for 2007. Once we have all the historical data, right, past data of annualized return, we simply take the average, so it will become average annualized return. Okay, so average annualized return is simply the average of annual realized return. Okay, so 1.1 divided by t means 3 years, 1, 2 and 3, and this is the year 2005, 6 and 7, and you are investing for 2008, so it means you should expect this return if you are investing. And how did we get it? Based on some historical data. Okay, and this is, we call it as arithmetic average return. So based on the historical data, this historical data, if we are investing in the future, because we normally invest in the future, right? So how much should we expect? We can take some historical data, history. So we should expect this are average if we invest in the stock. Okay, so the first measure of return is the historical return. So once we have the historical return, we can also find the historical risk. Now can you see the next question, that as you invest for the future and the future is of course uncertain, what are the chances that you get less than your expected or less than your expectation, or what I call it as average annual returns, or in other words less than R. Okay, so what are the chances that you are going to get less than what you are expecting for your investment in stock A? And this is called the risk. Okay, so risk means when you get something less than your expectation. For instance, you are expecting that you are going to get A in this corporate finance unit, but sorry, B plus, your expectation is B plus. So this is your expectation, but if you get B, that is your risk. But if you get A, that is not your risk. Okay, so based on your expectation, if you get less than what you are expecting, that is the risk. So how do we measure this risk? Beyond this, B plus is not your risk. Okay, so risk is said to be present when investors are uncertain about the outcome of the investment. We don't know. The risk on the asset is measured by the variance or the standard deviation of returns, which is an estimation of the volatility of returns. Okay, so there is another example in next slide. So first you need to understand that we just got historical return in the previous slide, and based on that historical return we got our bar, that is arithmetic mean or the average return. And once we get this return, we can find historical risk. Okay, so how do we measure this historical risk? Variance is this variance. If we take the square root of this variance, we get standard deviation. Okay, so I'm not explaining this part because I will explain it with the example. Okay, so it means you are here now. So you want to invest for maybe you want to invest for the coming years, and you are standing here. Okay, so it means you have the data of past 5 years, 1 2 3 4 and 5, and you want to invest an S&P 500, and you want to know whether should I invest or not, and what would be the uh, risk. So there are two questions in your mind: what should be the return and what should be the risk, right? So because you have some past data, so based on past data you can expect something. Okay, so that is the annual realized return. Remember, this is not a realized return, instead it is annual. So remember in the slide when we did 1 plus r 1 plus r 1 plus r to get this annualized return. Okay, so how did we measure this 4.9? We just taught you 1 plus r 1 plus r, then that was equal to 1 plus r. Okay, r1 r2, and then for 1 year for 2005 you got it. Okay, so this is you already know. And similarly we can also find for 2008, 2007, 8 and 9, 6, 7, 8, 9. Okay, so how do we measure the first of all historical return? This is r bar, so it is equal to 1 plus d, uh, first annual realized return, second and last one. Okay, we simply add them and take the average, and it should be 3.14. So that is what you should expect, what you should expect. Okay, this is your required return. Okay, so how do we measure this historical risk? We also call it risk or volatility. They are the same thing. Okay, so this was the data. If you see 2005, 6, 7, 8, 9, I just did it in a column form so that it's easy for you. So return was given, that is 4.9 every year's return, and we found 3.14. So that was called the arithmetic mean or average annual return, right? So once we have this, then we can find the risk. How do we find the risk? We need to see that we have to subtract this average from every annual return. Okay, 4.9 minus 3.14, then 15.8 minus 3.14, 5.5 minus 3.14, and you simply get this deviation. So this is called the deviation. Okay, difference between expectation and this realized return is called the
deviation, right? So deviation from the mean, so this is the mean and this is the deviation. Deviation from the mean of this return is this one, deviation from this mean of this return is this one. Okay, so once we have all these deviation, few deviations are positive and few are negative, so what do? We take the square. Okay, so once we get the square, everything becomes positive. Okay, and then we simply add them. Sorry for this Lazada email notification. Okay, and you see, uh, r minus r bar mean 2005 minus r bar square. You have to take the square of every deviation, and then you need to do t minus 1. That is how many years? 1 2 3 4 5. It would be 5 minus 1, and your answer would be 581.463. So it means your variance is 581.463%, right? So it means the overall variance of your return is 581. But we need to find the standard deviation, because if you see, these are the square form, right? So that's why we can understand the answer would be very high. But we few values were positive and few were negative, so that's why we need to do the square root of this answer. Our answer would be 24.1. So we can say that 3.14 is the return and the risk is 24.11. Okay, 24.11% plus minus. It can go either up by 24.11% or it can go down by 24.11%. Okay, the next topic is expected return and risk based on future data. Okay, if you see this slide, I wrote it probability based return and risk. Okay, so before going for this slide, my question is, if I ask you how much would you score in this corporate finance course, can you answer? Okay, because this is the first time you are doing that, you are not sure, so you will say that maybe you will get B, you will get C, you will get A, and you will get, right, but you are not sure. Okay, if I ask you, you are expecting B, how much are you sure? You cannot tell exactly. Okay, and if I ask you how much are you sure to get C, uh, you will tell me 70%, 80%, right? So it means you are not 100% sure. So that's why you can say that you are telling it on the basis of chances. Okay, chances are basically probabilities. So in this case, you can tell your this B mean expectation or expected return based on the chances. Okay, and next question is, what is the average score of students in corporate finance course and what is the risk? If I ask you overall what is the average score of this unit, you have some historical data, right? So based on historical data, you can find overall average, and also you can tell how many students they actually failed. You can also find the risk. Now can you see that you can find your risk and return using the future data, and in some cases, right, in your case, when I ask you how much do you score, and in other cases you can use the historical data. Once you have some previous data, you can do that to calculate risk and return. Now I'm just giving you another example. For instance, if I ask you that what are the chances that you will get 60 marks, you will say that maybe it is 40% chances that you are going to get average mark 60. But should I take this average? Should it be your 100% expectation? No, that is just 40%, right? So 40% you can say that I may score 70, and 20% you may say that you can score 90. So you see, because you are not 100% sure and you are basing your marks on the basis of some chances, right? So you are giving some weights, 40% weight, 60% weight, and um, sorry, 40% weight and then 20% one, then this is your final weight, 100%. Okay, so how much should be the marks, what should be the marks at this 100% then? So it means you need to simply uh, calculate the weighted average, right? So how do you find the weighted average? Marks multiplied by probability, and this is called the possible marks, possible marks, possible marks, possible probability, and possible probability. So that's why you can also call it as MI and PI, individual marks, individual probability, right? So you will do 60 multiplied by 40%, then 70 multiplied by 40%, and then 90 multiplied by 20%, and then you simply add them. It would be your average return or average. Okay, so because we don't have any past data, so we cannot simply calculate based on our expectation, we can find this one. Okay, so in this case no need to divide it by n or t, so you simply multiply your probability with the marks and then add them. So that would be your average or your expectation. Okay, if I follow that example, so expected return and risk is weighted average of the possible returns from an investment. Remember, possible outcome, right? Where each of these return is weighted by the probability. So probability multiplied by R. So P multiplied by M in our previous case, if you see, probability of R multiplied by R. Okay, so P R 40%, then your return plus, so it makes 100%. Okay, so expected return is basically the product of probability of a particular return and that particular return. Okay, so note that if each of the possible outcome is equally likely, once it is equally likely, it means every outcome is equal, then it simply uh, then expected return would be 1 by n, r1, r2, and n rn. Okay, so this part we just learned how to find the expected return based on the probability. Next turn is the variance, right? How do we find the variance? Variance is equal to probability multiplied by r minus expected return. So this is the average return that you got. How did you get it? P into R. Okay, you got this average return and then you subtracted it from the possible return, so that would be your deviation, right? Once you get this deviation, you then square it like in previous case. After that you multiply it. In the previous case you divided by t minus 1, but here you are multiplied in the probability. Okay, so that is how you get the variance. Let's take an example, computing the expected return and risk. Okay, so annual return, if it is, you're thinking that the recession would, the chances for the recession is 40%. When it is recession you expect 5% because you will expect less, right? If it is normal you will expect something more. So 40% you believe that if you invest in the stock, right, then if it is a recession, there are 40% chances that there will be recession, you will expect 5. If 40% normal, 7. If it is a boom, then you will expect more, right? So these are called the possible annual returns, and this is called the possible probabilities. Okay, so what is the average? The average, we multiply the possible probability multiplied by for the expected return, we multiply the probability that is possible with the possible return, and then we take 7.2%. Remember, this is the weighted average. Okay, why? Because we have weights 40%, 40%, and then 20%. We have used these weights. Next, once we got the average, and the average was 7.2%, so we can simply uh, find the risk. And how did we find this risk? This is exactly the same thing like we did in the previous case. So the possible return minus expected return. Expected return is 0.072. You get this answer, and likewise we 0.07 minus 0.072, square it and then simply add them all. So that would give you the variance. Once you take the square root of this variance, you get the standard deviation. Okay, so these are the two ways to calculate your risk and return. One is the historical and one is the based on the future data. Okay, once we got the standard deviation, we write it like this. Okay, this standard deviation is called the total risk. Remember, this is called the total risk, and in this total risk we have two, we can classify them into two risks. One is systematic risk and other is unsystematic risk. Okay, so this is a systematic risk. We normally denote it beta, and that is unsystematic risk. We will cover this these elements after some time. Okay, but remember, this standard deviation shows the total risk of the company. Okay, so it is useful in evaluating returns in finance because the return on many assets tend to be normally distributed. Tend to be normally distributed means that sometime you get positive return, sometime you get negative, right? So the that is always a normal distribution. Okay, so there are very less chances that you get some return that are very much negative, and sometime there is a boom, right, that you get maximum return. But overall the situation in the market is normal and you get average return, right? So this is some extreme case that you get positive, and there are some extreme cases that you are getting negative. So it means the returns on the stock, they follow the normal distribution. Okay, and the standard deviation provides a convenient way of computing the probability that a return on an asset will fall within a particular range. Okay, and standard deviation, normally if we get the standard deviation, we can really tell that this is the average, and we can really tell that whether the stock will fall within what standard deviation. Okay, 0 plus 1 standard deviation, negative 1 standard deviation. Okay, so if you know the standard deviation, you can exactly tell if you from you can, for instance, you got the average return and you also got the standard deviation. So if you know the standard deviation, you can exactly tell that if you invest in the stock, what would be the risk and what would be the range actually where your next return will fall. Okay, so the stand it actually tells you where the next return will fall within a particular range. Okay, so once you have the average is r bar, that is average return, and plus minus when we do the standard deviation, this is normally we do, right? But if we do 95% confidence interval, mean r bar plus minus 2 standard deviation, so it means your confidence interval should be 95%, means there are 95% chances that the return will fall within this plus minus 2 standard deviation and plus minus this plus minus 2 standard deviation. Okay, so for instance, there is another example in the next slide. I will explain in more detail. So there are many prediction intervals. There are 99% chances, there are 95% chances, that there are 90% chances, right? When 99% chances that you are going to get this return, it means what is the level of uncertainty? That is 1%. Okay, so you are 95% sure but 5% not sure, right? You're 90% sure and 10% not sure. So instead, I am sure that you have learned the normal distribution. So this is the normal distribution where this one in the center we have the average, and in our case in finance we call it as R bar. Okay, and then we calculate the standard deviation. Standard deviation, for instance, it's 2 point something, so it means then we can standardize it, the return using the standard deviation, mean plus 1 standard deviation, negative 1 standard deviation, and then we have plus 2 standard deviation and negative 2 standard. If we have more standard deviation, high standard deviation, if you see, then you can exactly predict the return more confidently. But if your range is very less, the return may fall here or may fall here. Okay, so using the information of standard deviation, we can really tell where our next return will fall. Okay, so this is the mean, or where the average return should fall. This is the average or starting point, and standard deviation actually shows the dispersion So it means if you get actually this return, so this is the distance from the mean, and if you get the return here, this would be the distance from the mean. Okay, so this is just an example of finding that range. In our previous example, we found that the average return was 3.1% and the standard deviation was 24.1%. So we can write it as like that: R bar plus minus standard deviation. Okay, and when we say one standard deviation means we are 99% sure, uh, the confidence interval is 99% and we are 99% sure that return will fall in that range. But if we want to do 95%, then we have to do plus minus 2 standard deviation. Okay, so what is the 95% confidence interval for 2010's return? Okay, so um, so how do we do that? Average return is 3.1 plus 2 multiplied by 24.1%, and your answer would be negative 41.1%. And if you do use positive 1, your answer would be 51.3. Okay, so what is the uh, range would be negative 45.1% to 51.3%. So it means if you invest in S&P, okay, so 95 times, if you are 95% sure that your return will fall actually within this range. Okay, so this is how you calculate the confidence interval. Now the next topic is risk and diversification. Okay, so before this topic, remember that we have understood how to calculate our return as well as standard deviation using both historical as well as future data. Okay, we know that how to calculate it for any asset, or maybe any security. For example, we are investing in Apple, only in one stock. Okay, so the risk was called total risk, and total risk was standard deviation. And standard deviation we had system was equal to systematic risk as well as unsystematic risk. So the total risk of a company is represented by standard deviation, and in that total risk we have some market risk, that is systematic risk, and we have some business risk, that is unsystematic risk. Okay, so systematic risk is also called market risk, non-diversifiable risk, or we call it as common risk. Market risk, for instance, if a central bank increases the interest rate, this interest rate is common to all the economy or all the securities, right? So this is not unique to any particular asset, so this is unique to all the assets. Okay, so that is called the market risk, mean it is in the market and affects every asset in the market. It is non-diversifiable, mean we cannot reduce it, and it is a common risk common to all the stocks. Okay, so variation in the assets return due to market wide news that affects the economy as a whole, this is very important, and therefore all the companies and securities in the market simultaneously. So for instance, Federal Reserve announced a lower interest rate in an attempt to boost the economy. So if interest rate increases, it will affect all the sectors in the economy, or all particular stocks, that are basically all the stocks in the market or overall economy. And this unsystematic risk is called the business risk, right? And this is also called unique risk, diversifiable risk, or independent risk. We also call it as business risk, the risk that is particular to a business. Okay, so and it can be managed. And variation in asset return due to industry specific or a firm's news that do not affect all the companies. For instance, A and B, they merged, so that is a unsystematic, that is also called, that is a news that is related to the company, so it is not affecting all other companies in the market. Okay, so that's why it's called unsystematic risk. For instance, a firm announces that it has been successful in gaining market share with the industry, so this unsystematic risk can be eliminated while systematic risk cannot be eliminated. So in the total risk, if we can uh, if we can reduce this, which risk can be reduced, we actually reduce systematic risk. So it's called diversifiable risk, and this one we cannot reduce it, and that's why we cannot diversify this particular risk. Here are a few examples to differentiate between systematic and unsystematic risk. The risk that oil prices rise, increasing production costs. So this is common to everyone, all the companies, right? So that is a systematic risk. The risk that the CEO is killed in a plane crash. So this is a company's news. So that is unsystematic risk. The risk of a key employee being hired by a competitor. Again, this is a unsystematic risk. The risk of a product liability lawsuit, this is also again uh, unsystematic. The risk that the economy slows, and it's systematic, of course, that is an economic news. The risk that your new product will not receive regulatory approval, so again that is an unsystematic risk. The risk that the Federal Reserve raises interest rate, this is a systematic risk. So market, that particular news that affect the overall economy is called, and that is basically a systematic risk. And any news that doesn't affect the overall economy but is specific to the company, that is called unsystematic. Now the question is, why all of a sudden we started discussing this diversification? In fact, we were supposed to talk about only risk and return. Then why is the need to discuss this diversification? Actually, if you invest in stock and only stock A, okay, for instance, you have some money and you want to invest in this stock A, okay, so maybe you can get some profit, but there are chances that some some news has hit um, this this particular stock, so you lose all the money, right? So investing in a single stock, for this stock you calculated some return and then you got some risk, and then you invested your money in this stock, right? So in while investing in this stock you can earn more profit, but it can also happen that you can lose all the money, or maximum loss you can face while investing in the stock. So if diversification says that instead of investing only in one stock, it's better to invest in many stocks A, B, C, D, or in other words, make a portfolio, right? When we make a portfolio, so it means in that portfolio we have some risky one, we have some less risky one, we have some stock that are not very, that are actually average, that are not either risky, not nor actually less risky. Some stocks we have, maybe they are very safe, okay. So instead of investing in one stock, if we make a portfolio, so it means we can reduce the risk, we can reduce the risk, and this reducing the risk through portfolio is called diversification, right? So it means previously we were just dealing only one stock. Now we are talking about number of stocks in a portfolio. And when we make a portfolio, and remember this stock has some risk and return, this also has some risk and return. Every security has its own risk and return. So when we combine all these securities, then we call it as, let's say, portfolio 1. Okay, so this is portfolio 1. So can I ask that whether this portfolio has also its risk or return? This is one portfolio. Again, there is another portfolio. For instance, we have X, Y, Z, A, B. Okay, so this is portfolio number 2. So maybe this portfolio is more risky than this portfolio, or this portfolio is more risky than this portfolio, right? So, so we only know the risk of this security and return of this security, risk of this security, return of this security, but we can also calculate the risk and return of every portfolio. Okay, now we are talking about return of the portfolio and risk of the portfolio, because not all the portfolios are equal, like not all the securities are equal in terms of risk and return. So it means when we make the portfolios, we are actually diversifying. And remember, what type of risk can we diversify? Because we just knew from the previous slide that we have systematic risk and unsystematic risk. So which risk can be diversified? This cannot be diversified. That was non-diversifiable risk. We can reduce this unsystematic risk. So it means we can only reduce unsystematic risk, or that is also called a diversifiable risk. So in this diversification strategy, we have two or more assets, minimum two, or maximum it can go any number, whose values do not always move in the same direction. So it means if this is giving us maybe from this portfolio, if A is earning, maybe B is not earning much, or B is earning less, so they are very opposite. So if so in this portfolio, it means that we have different varieties of assets that move in the opposite direction. So if anything in the economy happens, so overall it does not affect all the stocks equally, right, or in the same way. Okay, at the same time, in order to reduce the risk, when assets price move in the opposite direction, the change in the value of one asset may, so if it is making profit, it will, maybe it is making loss, so it will offset, right? So the changes in the value of the assets may offset to some extent by the change in the value of the other asset. This can cause the overall volatility in the value of the portfolio to be lower than if it were invested in a single asset. So overall, what will happen? The risk will reduce. Only if we had invested in B, we could have lost a lot of money. But if we are putting it in the portfolio, this loss is offset by some other asset. So we can reduce the risk. Investors can only diversify away the unsystematic risk, but cannot diversify the systematic risk. I already told you, uh, unsystematic risk is a diversifiable and systematic is non-diversifiable. So with complete diversification means what? If we make a portfolio where there is no unsystematic risk, that is called the complete diversification, right? And all the unsystematic will be eliminated from the portfolio, and the only systematic risk would remain. So if we make a portfolio, a complete diversification means no unsystematic risk. So we, in total risk, we have systematic risk as well as unsystematic risk. And if it is a completely diversified portfolio, it means then there is no unsystematic risk. The only risk is just systematic risk. So remember, a full diversified a full diversified portfolio has only one risk, and that is the systematic risk. Now, if I ask you that there are two portfolios, right? This portfolio has many securities and this has only three securities. If I ask you which of the portfolio is more risky, of course this is more risky than this one because it has more stocks, right? So here we can say that majority of the assets would be offsetting each other's loss, right? But here we have only three, so it means higher the number of assets assets in a portfolio, lower will be the risk. Higher the number, lower will be the risk. Okay, and in an ideal case, there will be no, higher the number of assets in the portfolio, higher will be the diversification, right? And here it is the this portfolio is risky because diversification is less. Now, so volatility of a portfolio as the number of assets increase. So if you see this graph, here we have number of stocks and here we have a portfolio volatility. So the total risk would be unsystematic, right? Unsystematic as well as, sorry, systematic plus this unsystematic. So that would be your total risk. Okay. So as we start adding our stocks in the portfolio, the systematic risk will remain constant. It means the market risk won't change. However, if you see, the unsystematic risk will start decreasing and it will get to only one risk, that is systematic risk. Okay, so the total risk would be only systematic risk, because the unsystematic risk uh, has uh, has 200% diversified. Okay, so it means higher the number of stocks in a portfolio, or higher the number of assets in the portfolio, I should say, uh, then higher would be the diversification of the portfolio. Okay, so as we increase the number of stocks in a portfolio, the standard deviation of return of the portfolio decrease. And when I say standard deviation, it means the total risk, remember. Okay, why does it decrease? Because unsystematic risk, it starts going down. If you build a large enough portfolio, you can diversify away all the unsystematic risk, but you will be left with only systematic risk. And normally, if you remember, in the finance courses, we say that the market risk is called beta, right? Beta shows the market risk, and beta for the market is always equal to 1. What does it mean? Beta is equal to 1. Okay, to understand this, just look at this S&P 500. So S&P 500 means what? So it means this is a portfolio, and this portfolio has 500 companies, right? S&P 500 index means this portfolio has 500 companies, and the beta of this company should be equal to 1. Let me explain why. For instance, this is S&P 500. So it means we have 500 companies in this portfolio, right? So this is a market portfolio. In this portfolio, we have all possible companies. Remember, all possible companies, and in that we have 500 companies. Okay, so for instance, every company has its systematic risk, unsystematic risk. Every company has systematic, unsystematic, systematic and unsystematic risk. Okay, so if we include all possible companies in a portfolio, then this risk of one, then particular unsystematic risk, would be offset by another one, right? So because we have taken all the possible companies in the portfolio, so risk, if one is losing, other one is making profit, so our unsystematic risk of overall portfolio will become zero, right? So will become zero. So the if we say the total risk is equal to systematic risk plus unsystematic risk, right? So it means if this unsystematic risk becomes equal to zero, because we have added all possible companies where the risk of every company is offset by the uh, other company, so it means we have 100% diversified, means we have made unsystematic risk equal to zero. Although for instance, this A company, its unsystematic risk is 1.2, sorry, yeah, 1.2. So it means 1.2. What does 1.2 means? It means, okay, before discussing this, let me complete this one first. Okay, so it means the total risk of the company would be equal to only systematic risk, or in other words, 100% risk of this portfolio is systematic risk, right? Or 100% we can write it as 1. Okay, so that means beta beta shows the 100% risk of this 500 is 1, right? So that's why we call it as market beta equal to 1. Then we have a discussion of stocks beta. So some stocks might be more risky than the market. We will discuss in more detail in the coming slides, okay? Because at this time it won't be easy to understand. Okay, now that is called the portfolio return. Once we know that if we make not all the portfolios are equal, right, in risk and return, so it means how do we measure the return and risk of the portfolios, okay? And as we know, in each portfolio we have assets, and in each asset we have its own risk and return. Then how do we find the portfolio risk and return? Okay, and first of all, we need to understand that the portfolio weight should be the relative investment in your portfolio, that is equal to weight of every security is equal to weight of the investment divided by total weight of the investment, and portfolio return is equal to weight of security 1 and return of security 1 plus weight of security 2 multiplied by weight of security 2, and weight of security n multiplied by return of security n. So it means we can find the return of the portfolio, and this return is called the weighted return, okay? And also um, if you see, the portfolio weight would be 100% because we have many securities 1 2 3 until n, right? So it will make a weight of 100%. So let's take an example, then it would be easy to understand. Okay, so this is the portfolio expected return. How do we get it? Suppose you invest 10,000 in Boeing A stock and 30,000 in Merck stock. You expect a return of 10% in the first stock and 16% for the Merck. So what is the expected return for your portfolio? So first of all, we need to find the weight, and weight of the first BA is 10,000 is invested, and the total weight is 10,000 plus 30,000, 40,000. So 25% is invested in BA, and 75% is invested in Merck. Okay, and you see the mark return is 16%. Okay, so what is the portfolio return? So that is equal to return of the portfolio. We can also call it as expected return of the portfolio is equal to weight of A multiplied by expected return of first one plus weight of B plus expected return of B. So our answer would be 14.5%. And now it means where did we get this the expected return of A and expected return of B? So as we know, for there are two stocks A and B. So how do we measure this expected return? So either we can measure it using the historical return or future return, future based or probability based. So we can do that, right? So it means individual securities return, we can get it the way we used to get it in our previous slides, and only difference is that we are adding weights. Okay, so this is portfolio return in some given time. Okay, so for instance, you invest 100 shares of Harley Davidson at $40 per share and 230 shares of Yahoo at 25 per share. Okay, so if the price of Harley Davidson increases to 50 and the price of Yahoo decreases to 20, what is the return on your portfolio? First of all, we need to find the original value of the portfolio, that is equal to 100 shares multiplied by 40 is the price plus 230 are the shares of Yahoo and 25 is the price, so that is the 9750, and the new portfolio value would be 100 share, the price increases to 50, and this one for the second one price decreases to 20, and this is the value of the portfolio in time t plus 1, and this is at time t. Okay, so simply once you get it, you can simply find the return. So that is return 96,000 new value minus old value divided by old value, you get the portfolio return. Okay, so that is a simple return calculation that you last time calculated for the individual stocks. Okay, now let's talk about the portfolio risk. Okay, so as you remember, the expected return of the portfolio is equal to, we just simply take the weights of A, R of A plus weight of B, R of B, right? A simple weighted average. But for the risk, we cannot take a simple weighted average. We cannot really take a simple average. Okay, to find the portfolio risk, we have to we need to know we need to know, sorry, two major aspects. Number one, the risk of the component stocks, every stocks A and B, every stock standard deviation, right? Stock standard deviation of A and standard deviation of B. Number two, degree to which they move together, that is called the correlation. Okay, so we need to know the three major parts. Number one, standard deviation of securities A. Number two, weight of security A. Number three, A and B, and correlation of A and B. Okay, correlation means, for instance, the if stock A is making profit, then B is losing, right? So it means then they are moving in a opposite direction. So for a diversification, it's good that if the stocks are moving in the opposite direction. So higher the correlation means higher they move in the opposite direction, and higher would be the diversification. It means if A is earning and we are losing in B, still we are making some, we are reducing our risk. But if A also is making profit and B is also making profit in the same direction, they are moving in the same direction, then it means their correlation is positive. So for a diversified portfolio, it means to reduce the unsystematic risk, we should have negative correlation. Okay, and the correlation value can vary from negative 100% negatively correlated to 100% positively correlated. Okay, this is the correlation uh, strand. If you see this part, zero means then there is no tendency, they don't move, they we cannot predict any movement. Okay, and positive tend to move together, means if it is less than plus 1, so it means they tend to move together. And if it is negative but less than negative 1, then they tend to move together oppositely. But if it is positive 1 plus 1, so it means they always move together in the same direction, right? But if it is negative, then it means they move in the opposite direction. Okay, and this is very important for the diversification. This part, the negative the correlation is, better it is for the portfolio, uh, to get diversification. Okay, so when will the stock returns by high correlated with each other? Okay, stock returns tend to move together if they are affected by similarly economic events. Stocks in the same industry tend to have, so for instance, if it is a computer industry, so if anything happens, if we have, for instance, if we have a portfolio, and in the portfolio we have A and B, and they both the stocks are, um, they belong to the same industry, so it means they will move in the same direction, right? So if the stocks they belong to the same industry, they are positively correlated. Okay, they have strong correlation, and that is positive. So better when we are making portfolio, try to make portfolio that have the negative, or that or add the stocks from the different industries. So A is, for instance, software industry, then B maybe cement industry, C pharmaceutical industry. These portfolios are actually good, and they are very diversified. Okay, then this is the formula for risk of the portfolio. We know the formula of return, but let's see what is the risk formula for the risk. So that is equal to, so you remember the formula A plus B square. So it is always equal to A square plus B square plus 2AB, right? So if I say um, weight and standard deviation A plus weight of B standard deviation of B square, can you do that? So you will write W A square standard deviation of A square plus weight of B square standard deviation of B square plus 2 weight of A, weight of B, standard deviation of A, standard deviation of B. So this is the formula that is actually used in this uh, return of the portfolio. But we have to adjust one more thing, that is plus is or multiplied by correlation of A and B. That is the extra thing that you need to do. Okay. So you need to remember this formula. So weight of 1 standard deviation of 1 square plus weight of 2 standard deviation of 2 square plus 2 weight of 1 weight of 2 correlation of uh, R1 R2 standard deviation, sorry, yeah, correlation of for stock 1 and stock 2 and standard deviation of stock 1 and stock 2. Okay. Sorry, in the previous example I discussed that in the portfolio, in the in in the sorry, in this slide, so we don't actually need the, oh, okay, sorry, correct. So you need to understand that the risk reduction is maximized when the correlation between the return on the two securities is negative, means they belong to different industries. Okay. So the lower the correlation, mean negative is the correlation between the two securities in a portfolio, the lower portfolio variance or lower is the risk of the portfolio. Okay. So the risk of the portfolio is lower than weighted average of the individual stocks volatility, unless all stocks will have the perfect positive correlation with each other. So this is a very important statement. So it means if the correlation between the two securities is negative, it means the risk of the portfolio would be less than, if we have if less than the risk of individual securities, until unless we have all the stocks that have perfect positive correlation. Okay. So that is the statement that you need to understand. So finally, if I ask you what is the portfolio risk, you need to say that what is the formula. Portfolio risk of the portfolio is equal to weight of uh, A standard deviation of A plus weight of B standard deviation of B square correlation uh, A and B. Okay. So if I open this, so weight of A square standard deviation of A square plus weight of B square standard deviation of B square plus 2 weight of A, weight of B, standard deviation of A, standard deviation of B, and correlation of A and B. Okay. Okay. So let's see, computing the volatility of two stocks portfolio. Mean we need to find the portfolio risk of the portfolio. Okay. Using the data from table below, what is the volatility standard deviation of a portfolio with equal amounts invested in Apple and Microsoft stocks? And what is the number one? And what is the number two is what is the standard deviation of portfolio with equal amount invested in Apple and Starbucks? There are two cases. Number one, weight of investment in the Apple is 50% and weight of investment in the Microsoft is also 50%, and the standard deviation of Apple is 0.141 and standard deviation of Microsoft is 0.28, and correlation of Apple with the Apple of course is 100%, they are similar, right? But correlation of Microsoft with the Apple is 0.48 and it is positive. Okay. So positive correlation is there. And if you see Apple with the Apple, of course it would be 1, and for the Starbucks with the Apple is 0.38. So which one of the two stocks have the higher correlation? We will say that they have a positive correlation and they have the Negative correlation, because if you see, they are somehow from the related industries, but Apple and Starbucks, they are not in the related industries, they are totally different industries. So that's why they tend to, they don't really follow their prices, they don't really follow the same direction normally. So if you follow this example, so variance of portfolio or risk of the portfolio is equal to weight of A, mean Apple, and standard deviation of Apple is 0.41. So 50 and 0.41 plus weight of Microsoft is 50, and the standard deviation of the Microsoft is 0.28. 50 and 0.28 plus 2 weight of A, weight of B, standard deviation of A, standard deviation of B, and correlation is 0.48. Sorry, this is standard deviation and there is the correlation. Okay, and the answer is 0.089. So that is the risk of the portfolio of the two stocks, that are Apple and Microsoft. And what about the stocks, the portfolio of Apple and Starbucks? So 50% is the weight of the Apple, and 0.41 is the volatility, 50% is the weight in Starbucks, and 0.32 is the volatility, right? Plus 2 weight of 1, weight of 2. This is the correlation, that is 0.38, and standard deviation of 1, standard deviation of 2, and 0.09255. And if this is the variance, but what is the standard deviation? Standard deviation is 30.404%, and the standard deviation of this one is 29.9%. So after calculating, so if you compare, this one has a risk of 29.9%, and this is the second portfolio has a risk of 30.40%. Okay, and okay, in this slide, if you see, to compute the volatility of portfolio, we need the weights, standard deviation, and correlation of the two stocks. Okay, and as you see in the previous example, the first portfolio's volatility was 29.9%, while uh, the risk of Apple and Starbucks portfolio was 30.4%. And if you see the example in the portfolio of Apple and in Starbucks, the volatility is less than the individual volatility of every stock. If you see from this table, Apple volatility is 0.41, while the stocks Starbucks volatility is 0.32 compared to 0.28 of Microsoft. You see the Starbucks volatility or the risk is higher than the Microsoft. But still, given this higher volatility of Starbucks, still the risk of the portfolio is not very much compared to the is not really high compared to the portfolio of Apple and Microsoft. So what does it imply? It implies that even though Starbucks is more volatile than the Microsoft, its lower correlation with the Apple. If you see the correlation of Starbucks with the Apple is lower than the uh, correlation of Microsoft with the Apple. That lower correlation actually helps us to get the greater diversification benefits compared to the uh, compared to those portfolios where the correlation is not really um, low, it's high. So higher correlation actually leads to the higher volatility compared to the uh, lower correlation. So the next question is why systematic risk is all that matters. As we know that out of the two types of risk, unsystematic risk is the risk that can be diversified. So if an investor is facing two types of risk, systematic risk as well as unsystematic risk, he can diversify this unsystematic risk by making a portfolio. So when a portfolio is made, we assume that the diversified unsystematic risk is 100% diversified and it is equal to zero. So the only risk that is left would be systematic risk. So when he is investing in the stocks, he should actually require the premium on the systematic risk, because the only risk that is left is systematic risk. So investors should be compensated for only systematic risk. This risk is non-diversifiable risk, and we need the compensation on the systematic risk. So the risk premium for a security is not affected by diversifiable risk, in other words, unsystematic risk, and it depends upon the amount of its systematic risk rather than total risk. So only systematic risk is awarded. And in finance, when we talk about the relationship between risk and return, we are actually referring to the systematic risk. Now, if you remember in the previous example I gave you for S&P. S&P index is 500 index, and this index means it's a portfolio of 500 companies. When we say a portfolio, it means the diversifiable risk or unsystematic risk of this portfolio is zero. The only risk of this portfolio is systematic risk. Systematic risk, and that is only the 100% risk. So we call this S&P 500 index as a market portfolio, right? So market portfolio is the portfolio that is used for the comparison purposes, and market portfolio always has a risk of has only risk of systematic risk, because we assume that unsystematic risk is eliminated to zero. Okay, so there is a return of this portfolio. We call it as rm is the uh, market return, or in other words, return of the market portfolio, and this has only systematic risk, and that is only 100%. The 100 only risk is 100%. Okay, beta is always equal to 1, so beta of market is equal to 1. Okay, so we call this as a base portfolio, so that when we are investing as an individual, when I'm investing in a stock, right, then I will compare the return of this stock with the market. So that is why it is used as a base for comparison purposes, if I'm interested to invest in the stocks. Now, this portfolio is actually value weighted index of all risky investment. All the investments, they are here, so that is actually a portfolio. So in practice, we often use stock market index such as S&P 500 to represent the markets like this. Okay, now systematic risk of an individual asset, remember that was the portfolio, but that is now the individual asset stock A, is really just a measure of the relationship between the return of this stock and return of this market. Okay, so this return market means the return of the portfolio, that is the market, and this is the return of the individual stock. So how do we measure this individual stock? uh, Historically we also calculated it, and also um, I told you in the previous slides how to measure the stock return. Okay, so the systematic risk of an individual, this one we assume that for this portfolio, uh, the 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 only risk left is the systematic risk, and that was equal to beta is equal to 1. But what about this stock? How can I find the beta of this A stock, right? So how can I find that? And assuming that it has the total risk, and it has an unsystematic risk and systematic risk, so how can I measure the systematic risk of beta of this individual stock, because the beta of the market we know it is equal to 1. But what about this stock's beta? How do we measure it? Basically, the beta of this stock is equal to the return of stock A divided by return of stock B. Okay, so the movement of stock A returns with the stocks as with the market return is called the beta. So beta of A, or the sensitivity or the systematic risk of stock A, is um, equal to return of A divided by return of the market. Okay, so if the stocks returns are highly sensitive to the market portfolio returns, so if these returns are highly sensitive to the, if it means if its answer is greater than, if it is equal to 1, so we can say that the return of the stock A is equal to the return of the market uh, portfolio. So they are equally facing the systematic risk. But what if the answer is higher than 1? So it means the return of the stock A is higher than the return of the market, so it means it's more risky. So higher the return also implies higher risk. And also, what if uh, the answer is less than 1? It means it is 0.8, 0.7. It means the stock is relatively less risky than the market. It is less sensitive, I would say, than the market. If security returns do not depend on the market return, then it has a little systematic risk, mean it has less than 1. So the question is, how did we find this formula? I will tell you in the next slide how did we got it. Okay, so based on the previous slide, we can say that the beta is equal to the return of particular stock A divided by the return of the market. Okay, so if beta is equal to 1, it means the same systematic risk as market. If beta is greater than 1, more systematic risk of that particular stock than the market. If beta is less than 1, it means less systematic risk. If beta is equal to 0, then no systematic risk. For instance, if the answer is 1.2, so it means this stock is 20% more risky than the market portfolio. Okay, so it means you are earning more from this stock uh, uh, than the than the market. Okay, to estimate beta we use historical returns. Okay, we use historical beta responds to the slope of the best fitting line in the slope of securities axis return versus the market axis return. So this is a very important statement: securities axis return versus the market axis return. So let me calculate it for you. As we know that in the capital asset pricing model, this topic we will cover in the next few slides. So CAPM is equal to RE, R of A, individual stock, return of individual stock is equal to risk-free rate, means if the rate of the T-bills plus beta of A stock, risk return of the market minus return risk-free rate. Okay. So risk-free rate is the basis rate. That is the rate that if there is no risk, right? So if I want to find the beta A, our answer would be RA minus RFR divided by RM minus RFR. So this is the securities axis return, and this is the market axis return. Okay, so if you see, the beta corresponds the slope of the best fitting line in the plot of a security axis return versus the market axis return. So if I cancel this RFR, so it would be RA divided by RM. Okay, so we will discuss it in more detail in the next few slides. Okay, so this was the beta of individual stock. So what is the beta of a portfolio? So beta of the portfolio is equal to weight of stock A, beta of stock A plus weight of beta n stock multiplied by beta of n stock. So that is a weighted beta. So this slide actually helps you to differentiate between total risk versus systematic risk. Suppose that in the coming year you expect Cisco stock to have a standard deviation of 30%, so that is total risk, and a beta market risk of 1.2. 1.2 means this is 20% more risky than the market, okay? And Unico stock to have a standard deviation of 41% and a beta of 0.60%. So it means this is 40% less risky than the market, okay? So based on standard deviation or the total risk, which of the two companies is more risky? So it means 41% is the standard deviation of Unico's. So it means this total risk wise, this company is more risky and compared to Cisco. But in case of systematic risk, this is this company has less systematic risk compared to the Cisco, that is actually more risky. Okay, so Cisco Corporation has a total risk, has a lower total risk than the Unico's stock, while has higher beta or higher market risk compared to the Unico stock. Okay, so the next question is it possible for a stock to have a high total risk but low systematic risk? Yes, as we just saw that maybe it has a significant amount of volatility, means it has a high standard deviation, but maybe it is possible that it has a lower beta, it has maybe a 0.6, it means its return compared to the market is less, and it is a its sensitivity is less compared to the market. Okay, so next topic is capital asset pricing model. So that is capital asset is stock. Stock is a capital asset. Okay, so how can we measure the price? Means how do we know the price of this stock? This stock. Okay, so this is actually stock valuation, stock pricing model. And if you see in the dividend discount model, you remember that price was equal to T naught 1 plus G R minus G, right? So if we are taking an investment perspective, we will write it as return, but if it is a firm perspective, it would be cost, right? So it means this R minus G, you can have R is investor perspective, and K would be company's perspective. Okay, so if we are talking about the company's perspective, we will call it as cost of equity capital. And if it is of investor perspective, it would be the return on equity. Okay. So this capital asset pricing model helps you to find the price of the stock, right? Remember in the dividend discount model, the cost of capital or R was given. R was given. So how did we find that R? How did we find this R? Actually, we can find this R from this capital asset pricing model. So R is basically called the return, right? Return on equity if we are talking about investor perspective. But if it is a company's perspective, we will call it cost of equity capital. Okay. But because now we are talking about risk and return, so I will talk about the uh, investor perspective. Okay. So how do we find return on equity? Return, if I'm investing in a stock, return on my equity would be equal to at least it should give me risk-free rate. So it means if I put my money in some utility bills, I would get some risk-free rate. Plus, because I'm investing in a risky asset, and the risky asset has a only one risk, that is what? Systematic risk, right? I will not use standard deviation, I will use beta. And what is the market return minus risk-free rate? So this model is basically called the capital asset pricing model. Capital asset pricing model, why do we call it? Because we get RE from this model and we use this RE here to get the price of that model. Okay, so that is systematic risk, this is the market return, this is and if you see, this is the market premium. Market premium, it means market is offering you 12%, 20%, and if you invest it in the T-bills you get 10%. How much extra? 10% is market is offering you, right? So it means, so this part is called the market premium, and this is the return. And remember what was the formula of beta? Beta was equal to RE minus RFR, right, divided by RM minus RFR, remember? So that was actually the excess return of the stock divided by excess return in the market. Now, so this is called the expected return. Okay, so it means if we want to invest in a stock, how much should I expect from that stock? Once I can get the required return or the expected return, I can use it here. You can also see that this is expected return, means you can also call it as required return. You want to require this return from this investment. Okay, so a baseline rate is compensation for the inflation and time value of money with no risk of losing money, that is risk-free rate. A risk premium that varies with the systematic risk, this is the risk premium that varies with the systematic risk. Okay, so this is the same relationship, expected return is equal to risk-free rate plus risk premium of the systematic risk. Okay, or in other words, risk-free rate plus beta risk premium per unit of beta, so that is RM minus RFR actually. Okay, so this is how you get it. So beta expected return is equal to risk-free rate plus beta expected return on the market minus RFR, so that is the excess return. So what does CAPM says? It says that the expected return on any investment on equity is equal to the risk-free rate of return plus a risk premium proportional to the amount of systematic risk. So this is a risk premium proportional to this systematic risk. Okay, if this answer, if this is equal to 1, so it means this market and this security, they have equal risk, and if it is more than 1, it means it is more risky than the market. Now let's take an example. Suppose that the risk-free rate is 3% and you measure the market premium to be 6%. When I say market premium, there is a difference between market premium. You need to remember these two words, market premium and market return. Okay. When I say market premium, it means the answer is already for this part of the equation. Okay. So that is 6%. But if the question tells you market return, so that is only RM. For instance, it's let's say it's 12% for instance. Okay, so it means RM. If the question tells you directly market premium, it means RM minus RFR. But question gives you market return, it should be 12 RM, not RM minus RFR. Okay, and you Apple has a beta of 1.2. It is 20% more risky than the market. According to the CAPM, what is its expected return? Risk-free rate is 3% and 1.2% is the beta and 6 is basically RM minus RF. Okay, the answer would be 10.20%, 10.2%. So that should be the, it means we should require at least 10.2% if I'm interested to invest in the stocks of the beta. So once I get this RE, and if I want to find the price, how can I find? So D1 divided by R minus G. I will use this R here. I will have dividend, I will have G, so I can find the price. Now this is the capital asset pricing model. Based on capital asset pricing model, we can draw a line that is called the security market line. Security market line is basically the depiction of the capital asset pricing model. So it means if there is no beta, so you can follow the equation that is equal to RE is equal to RFR plus beta Rm minus RFR. Okay, so if beta is 0, so this part will become 0, so our Re would be Re, and this is the beta here. Okay, if Re is equal to 0, we will have some RFR, that is RFR. So if beta is 1, it means it should increase with the beta. So if we keep on increasing this beta, our expected return will also increase. And let's say this is the market return. Okay, so this is RM, market return, and this is beta 1. Okay, so it means if the beta is 0.5, we should require this much of return. If the beta is this one, we should require this much of return. So all these points here are basically what it should be. Okay, these points are should be the rate. Actual rate in the market is different, but this rate is based on the formula, based on the capital asset pricing model, because we have incorporated all the fundamentals. So if the beta is 0.5, so it should give the return of this much. If beta is 1.2, this should be the actual, uh, this should be the ideal or theoretically correct return of that stock. Okay, so that line, this line, particular line is called security market line. Okay, so we can apply this SML and CAPM to portfolio as well as on individual securities. Okay, so we can do that. So let's understand this question. So there are two stocks. BFEE has a beta of 0.7 and Google has a beta of 0.9. Okay, if the risk-free rate is 3% and the market risk premium is 6%, risk premium means this is R minus RFR. Okay, remember. What is the expected return of an equally weighted portfolio of these two stocks according to the CAPM? So it means we have two stocks. This is stock number 1 and this is stock number 2. Okay, so can we find the return? How much should we require on the first PFE, and how much should we require on Google, right? So it means we can apply the capital asset pricing model to find the expected return. So the expected return based on the capital asset pricing model is RPP is how much? That is equal to 7.2%, and on the Google we should require 8.4%. Okay, so once we got this return, can we find the return of the portfolio? Yes, we can find it. A return of the portfolio is equal to um, weight of the first PFE multiplied by return plus weight of Google, return of this Google. Okay, so we can find the, simply it is equally weighted means this is 0.50 and this is also 0.50, and we can find the return. But if so this is one way, right? Simply we can do that. Okay, and why are we finding this formula? Because the question is asking you to, if you make a portfolio of these two stocks, only 1 and 2. Okay, so can we find the return of the portfolio? Yes, we can find. And also, if not, if we are not using this individual security way, we can also find in another way. First of all, we can find the beta of the portfolio. We can do that. So the weight of the first stock multiplied by the beta of the first stock, weight of second, beta of second, so that is the weight of beta of the portfolio. Remember, the beta portfolio is 0.8 and beta of the market should be 1. Remember. Now we can apply RFR plus beta of the portfolio, RM minus RFR, so the answer would be equal. So there are two ways to do that, so it's up to you, and normally we suggest this part. So you need to understand this graph. first of all, we know that there is a negative relationship between the required rate of return and the price. If required rate of return increases, price will go down. If it decreases, price will go up. So these are the, there is an inverse relationship between the expected return and the price. So if I, and also we know that there is also a positive relationship between the return and the beta. Okay, so can I draw this graph? I can draw this graph based on beta and return. And as we know that return is inversely proportional to the price. Okay, so it means if we know this thing from here, that price and R are inversely proportional. So it means if I'm writing R, you can also understand if R increases, price will go down. So the CAPM says, why I'm writing R? Because I cannot write P, because CAPM gives you R directly, not P. So this is 0. If there is no beta is 0, it will be RFR, right? So if the beta increases, so for the given betas, the ideal return should be on this line. Okay, this line is the ideal line because we got it through the CAPM. Okay, so that is the called the SML, security market line, because we got it based on CAPM. Okay, but this is theoretically we should get this rate. Okay, ideally we should get this rate, but what if in the market that is not the case? Let's say at this uh, let me, okay, at this 1.2 beta, let's say it says that the return should be 12%. Okay, it should be, return should be 12%, but in actual, in the market, it is more than that. It is 14%. Okay, what does it mean? It means ideally based on capital asset pricing model, the return should be 12%, but in the market it's actually, it is 14%. People are requiring 14%. So if I use 14% here instead of 12%, the price will be lower. So it means this stock, if I have this stock, it would be underpriced. It would be underpriced. Why pricing? Although you see this is return, but I'm calling it as priced. Why? Because I know that there is a negative relationship between the price and return. Okay, so look at this talk. So it means ideally at this level of beta, what CAPM says that you should expect this much of return, right? But people are requiring this return lower than the, when it is lower, the price would be higher. So it means this stock is overpriced. So students normally get confused with overpriced at the top of this line and underpriced at this line. So don't get confused. Okay, so because CAPM gives you the RM, so that's why, and we know that there is inverse relationship between RM and P. So you should, so when the stock is overpriced, and this is the stock that is underpriced. Okay, so when we have this situation, we call that there is a mispricing, because ideally the price should be this one, but people are requiring this much, so the price would be, we can find the price here in the market D1R minus G. But if you follow the CAPM, the price would follow this one. Okay, so what is the strategy? So if your asset is saying that people are requiring this one, but ideally this should be the return based on the CAPM, but in the market it is this one. So it means this is overpriced, so we sell the overpriced. So this is unattractive investment. Okay, so we should not go for this one. It is paying us less. Okay, and if otherwise, if at this level of risk we should expect this much, but this stock is already giving you higher than what you are expecting, so it means this is underpriced, so we should buy these assets. So this is a practical example.
So you are trying to decide whether to invest in one or both of the two different shares. Share 1 has a beta of 0.8 and an expected return of 7%. Okay. Share 2 has a beta of 1.2 and an expected return of 7 9.5 9.5%. Okay. So for a given level of beta, so the first of all, this beta is 0.8 and the beta here is somewhere here. Okay. And where is the risk-free rate? That is here, 4%. Okay, so risk premium is 6%. Remember, this is market risk premium. This is not market return. I repeat, most of the students they confuse it with RM. So it is RM minus RFR. Okay, so using the CAPM, what does CAPM says given these betas? And this is the expected return based on the CAPM. Okay, CAPM says uh, for the first share, the CAPM says at 0.8 level of uh, beta, the expected return should be, let's say it's should be here, I guess. Hmm. Okay, so it should be 8.8%. Okay, and if the beta is 1.2, your expected return based on CAPM should be 11.2. So let's say 11.2 is somewhere here. So at a given level of beta, so let's say this is here, so it is 11.2 for share 2 and this is for share 1. Okay, but actually the expected return of the first one is 7 here and the expected return of the second one is somewhere here. 9.5% is here and this is 7%. Okay, so remember, because the expected return has a negative relationship with the price, we know that D over R minus G. Okay, so if you see, if we use CAPM for the first case, right, for the first case, if we use CAPM, it would be 8.8%. Our answer will be lower, right? But if we use 7%, our answer would be relatively higher than 8.8. So this stock is overpriced, right? Overpriced means its price in the market is higher than what actually CAPM says. And for this case also, if we use CAPM rate 11.2, the answer would be lower than if we use 9.5%. So both of them are overpriced, and when they are overpriced, we are not interested in those stocks. Okay, the last topic is just the theory that is called the market efficiency hypothesis or theory, sorry, hypothesis. Okay, market efficiency hypothesis says that as an investor, if you are an investor and you want to invest in stocks, okay, then the price, the market price at which that stock is trading has incorporated all the information, right? All the information uh, in the stock price, so you cannot outcompete the other investors, right? So it means if you cannot outcompete the other investors, these investors have also incorporated this information. Okay, so once you have this information, once you have any information, then based on information, if you cannot outperform the market, then it means market is information efficient. Okay, so it means the market is information efficient if you cannot remember. But if you can outperform the other people in the market, then market is not efficient. Now, because this information has different levels, some information are very easily available, right? Easily available. Some are very, it requires some effort, and that is a public information, and some require information are private information. Okay, so it means if we need to see what kind of information we are looking at, right? So there are three forms of information. So based on informations, we can divide the market efficiency into three types. Number one, three forms. Number one is weak form market efficiency. This is the form of market efficiency where the information, and that information is only historical past prices, okay, is already reflected in the stock prices. So if past stock prices, if people are adjusting the or making decision based on the historical stock prices and still they cannot compete, outperform the other people, it means this information is already available to other people also, so they cannot outperform. So, and type of information is what type of information? Historical stock prices. Okay, and semi-strong form of market efficiency is if you can find the price based on maybe balance sheet, right, income statement. Based on this information, you are finding a price, and let's say price should be 103. So this price is actually also calculated by other people also. They have also calculated the price of 103 because this information is already available. So if you cannot compete or outperform the other market participants or the market, we also call it as market. If you cannot outperform the market based on this public information, okay, then it means market is good. So nobody can outperform each other. So that is a semi-strong form of market efficiency. And the last one is strong form of efficiency. So if as an investor you cannot outperform the people who have insider information, although insider information is not publicly available, so people, they use this insider information and they outperform, right? So if the managers or insider, they know that what company is going to do in the future, and then they take the then they sell or buy the stocks, then they can outperform the market. So if they can outperform, so it means market is not strong from efficient. But if they cannot, if they cannot, it means if even the insiders, they cannot outperform the market, then it means it is a strong form of market efficiency. Okay, so for instance, only to the managers, they know some private information. So even the managers cannot, if they cannot outperform the market, it means the market is very strong and it is efficient. Nobody can get the extra return than the other participants. Okay, thank you so much. That was all for today's lecture, although it was quite lengthy, but let me know if you have any question. Thank you so much.